don't forget, in March 2009, the S&P was at 666, and now we're up to close to 2,300. So this is a fabulous performance. Hardly any other president has had a stock market performing as well as he had. So the stockholders and the capitalists, the asset holders, they really cannot complain about him. They can complain about his policies, but they cannot complain about the money printing that happened and about the fact that wealth and income was diverted from a lot of ordinary people to the corporate sector and to the asset holders. Now, under Trump, we have certainly a more friendly business climate. That, I think, is quite clear. But some of his policies are inconsistent with creating much economic well-being. And we have had now a bull market that in March will be 8 years old. So we're in a very mature bull market, and we are, by June 2017, in an 8 years old expansion, which by any standard is a very old expansion. So whereas, say, President Reagan, he was elected in 1980, came into power in 1981, he had tailwinds. Trump has a lot of headwinds.
Let's talk about those headwinds, because many of those headwinds are, in fact, the creations of these artificially low interest rates, the distortion of the global financial markets due to the policies of the Fed, of course, that you've criticized for many, many years. But we also see, Mark, this movement by people who actually invest based upon their politics. So there were many people who just stood on the sidelines, missed out on that massive rally in the S&P 500, 175% increase, and they stood on the sidelines. And now that Mr. Trump, new sheriff, is in office, some of them are thinking, well, now's the time to get into the stock market. Are they wrong? Do you think we're closer to a top than we are seeing? Do we have much upside ahead in your mind in 2017, or are we near a top in the stock market in your mind?
Well, this is a very good question. First of all, it is correct. Between 2009 and recently, a lot of wealthy people had a lot of cash, and they owned properties, and they owned paintings, and they owned whatever. But they were not convinced that the stock market would go up. In fact, I know a lot of wealthy people, including hedge funds, that in 2009 were heavily short the market when it just took off massively. So what you said is absolutely correct. Many people have missed on the bull market, and now Trump is elected, and they read all this improved optimism, and they rushed into stocks. But we clearly have to see the U.S. stock market, by any standard, is now quite expensive. It's not a bargain. Number two, compared to foreign markets, the U.S. market is very expensive. In other words, the divergence between the U.S. stock market and foreign markets since 2011 is very wide. In other words, if you're bullish about Trump and his policies, in my view, you will find much better bargains in emerging markets, in Europe and in Japan, than in the U.S.
We really do enjoy global markets, and we've participated in some of the big uptrends over the last year. Peru, for example, broke out, some of the South American countries, and of course, Russia also was so cheap, and still really is in some cases. And we've seen Russia really emerge since the fears of these sanctions may be weakening now that President Trump is coming in. What are some countries that you like as we move forward into 2017? I've heard you recently mention India, that you like India. What countries do you have your eye on this year?
Well, basically, you're right. Last year, the three best performing markets were Russia, Brazil, and Kazakhstan. Whether they will be the best performing assets this year, I don't know. But I think in the case of Russia, it is true. equities are not yet particularly expensive. There's no bubble. There are other markets in the world that haven't done well and gone down. Say, last year, the poor performers were countries like Turkey, a disaster, or Nigeria. Now, I don't think there's a hurry to buy Turkey, but it's a market that has gone down a lot. Asian markets, some of them have performed well, but they're still on valuations relatively inexpensive. Secondly, I think we have to move a little bit away from saying, I like this market, I like that market, and so forth. I think over the last few years, as you know, there has been a huge trend towards indexing. People buy indices. They buy indices in the US,
ETFs,
the S&P, or in Europe, or in Latin America, and so forth. But I believe, since I live here in Asia, there are lots of opportunities in individual stocks, in other words, in active fund management. As you've seen also last year in the US, the FANG stocks, the popular momentum stocks, they didn't do well. Energy did well, and of course, the best performing sector, nobody likes to talk about because they all missed it, were gold mining shares.
You know, we actually, Mark, rode that rally back in February of 2016. We love precious metals. We actually have a what we call PACE. It's an acronym for precious metals, for P, A, agriculture, C, commodities, and E, energy. We think those four areas obviously historically have done well in times of panic and crisis and inflation, of course. But I've heard you recently saying that you believe those core areas could really do well, even as we move into President Trump's administration, because he does seem to be so aware of how to use debt, his understanding of leverage. It seems as if that's just that his policies may just bode well for gold and silver, even if stocks also rise.
Yes, I mean, I'm convinced that precious metals over time will go higher. Mr. Trump, no matter what he says, he's actually an interventionist. If the economy weakens now in, say, 2017 or 2018, don't you think that he will also print money? He will beg the Fed to launch QE4.
You know what will be very interesting, though, Mark, will be what will American or what will U.S. investors do if Trump pushes QE4, if he supports QE4? Do you think that they'll go along with it now that three bouts of this obviously have created a large bubble in the stock market? Do you think that the tone towards the Fed and towards intervention, that we're slowly becoming numb to it and that we expect it, and that maybe we'll invest, maybe the reluctance to invest in the stock market in previous times underneath President Obama will change? I'm wondering if you think volume levels on the U.S. stock market, even in the face of a QE4, could begin to surge, because that's been a big problem. Volume's been declining for a long time in the U.S. markets.
I tell you why volumes have been declining. The individual investor is no longer interested in stocks. He lost money after March 2000 in Nasdaq stocks. Then he regained some confidence in 2005, 2006, and got hit very badly in 2007, 2008. Then the market recovered, but he had lost money and he didn't participate. Furthermore, he gradually realized that the stock market is a very rigged game. It is manipulated by the Federal Reserve and other high-frequency traders and so forth. I'm not saying the high-frequency traders manipulate viciously, but the individual investor, by the time he buys something and sells something, it's already moved, so his transaction costs are very high. So they're absent from the stock market. That's why the individuals are no longer active But the big boys and what is being traded off the board is very high frequency traders. They may move their portfolio 50 times a day, 100 times a day, but the statistics do not show that.
Which sectors? I've heard you recently mention that you do believe energy stocks could do well this year, as well as commodities, agriculture, and in particular fertilizer stocks. Talk to us about why you think those things might see an increase in 2017. What's your thesis there?
Well, basically, agricultural prices have been trending down for the last couple of years. And last year, we saw some major lows in ag prices, and they started to move up. And the difference between, say, precious metals and agricultural commodities is this. And I'm not saying this in a negative way about gold, silver, platinum, but I'm just noticing the difference or highlighting the difference. Say you and I buy gold. We can store it for 100 years and take it out of our safe, since both of us will live 300 years and still have the same quantity of gold. You cannot store agricultural commodities for very long. They perish, even if the warehouse is perfect. So in other words, agriculture is produced every year. There is necessity for the world to buy these commodities to feed itself. And then there are occasionally surpluses and occasionally shortages. But it's never hoarded like gold, silver, platinum. That is a big difference. And so the price of commodities depends immensely on that particular year's demand and supply. And in the case of agricultural commodities, in general, and there are some exceptions, but in general, the stock is now very low. In other words, the inventory level is low. And if there is a poor crop anywhere, then prices will go up. And so I think that agricultural commodities, risk-reward-wise, are quite attractive this year. How do you play it as an individual investor? That's not so easy, because you can say, okay, let's buy sugar, or let's buy coffee, or let's buy wheat, corn, soybeans. The problem is that the individual investor, he would have to open a commodities account. With the commodities account, he has to roll over his contract every month. So unless the commodity, the underlying, goes up by 30%, he will lose money. It has to move because there's a future contract premium, the so-called contango. Mm-hmm. And so it's not easy for the individual to make money in commodities. But he can buy plantation stocks, he can buy agricultural companies that own fields and land, he can buy fertilizer stocks. So that is something that I would consider for an individual investor.